For the past 3 weeks, Berlin has been on edge. Washington's new tariffs, ranging from 15 to 20%, have shaken the very core of Germany's economy. Automotive giants like Mercedes, BMW, Audi, and Porsche suddenly find themselves caught in a single customs code that makes their vehicles more expensive the moment they cross the Atlantic. The famous Made in Germany label, once a familiar sight in American showrooms, is now becoming rare. The impact is visible on the ground. In Atlanta, a driving school has posted "Assign no S-Class reservations for now." At a Houston port, a Porsche container expected from Charleston quietly disappears from the manifest. These aren't just symbolic moments. They are the first signs of a much larger disruption. The numbers tell the real story. Washington's new tariff package, what some call Trump's Tariff 2.0, could wipe out $110 billion worth of German exports to the United States in one stroke. That's nearly 1/3 of Germany's entire U.S. sales channel. At first glance, it looks like Europe's problem. But the truth is, the sharpest pain may be felt inside the United States itself, in showrooms, supply chains, and even household budgets. So how does this tariff wall actually work? On paper, it looks simple. Washington has created a tariff matrix with 3 sharp blades, 25% on all passenger cars, 40% on sheet metal and aluminum parts labeled as carbon intensive, and 60% on electric vehicle batteries or anything linked to government subsidies. What makes this so powerful is that it doesn't just target a single model or a niche luxury car. By reclassifying imports under a single customs code, U.S. Tariff Code 8703, which covers passenger motor vehicles, every German car, from a family-friendly BMW X5 to a high-end Porsche Macan, gets caught in the net. Let's put this into real numbers. Take a Mercedes GLE, which usually ships with a price of about $55,000 at the port. Add a 25% tariff, and suddenly that vehicle costs an extra $13,750 before it even reaches the dealership. Once the chain of taxes, dealer markups, and financing are added, the sticker price at the showroom doesn't just rise by $13,000. It jumps by closer to $17,000. Overnight, the luxury cars that once carried prestige and strong demand are transformed into expensive, riskier purchases for American buyers. The same effect applies to BMWs, Audis, and Porsches, their showroom prices climbing by 12 to 15% instantly. And that's only the beginning, because once tariffs alter the baseline cost, everything connected to that product, financing, leasing, insurance, even resale value, gets reshaped. The reaction from Germany's automakers was immediate and dramatic. Within days of the tariffs being published, production and shipping schedules across Europe began to unravel. BMW halted container shipments of its X5 models from the Dingolfing plant to the United States. Mercedes announced it would slash exports of its EQ electric SUVs from Stuttgart by 50%. Meanwhile, 2 ships loaded with Audi A6 wagons headed for the port of Georgia were simply canceled. Entire vessels of cars that were already built, already paid for, were told to stay behind. The pain didn't stop at the big names. In Hanover, a medium-sized gearbox supplier announced that it would cut its employees' work week down to just 4 days. Why? Because in a single month, pre-orders for parts dropped 23%. The numbers forecast the scale of what's coming. According to the IFO Institute, Germany's manufacturing output could shrink by 2.8%, while exports to the United States could collapse by 38%. That translates to roughly 600,000 cars, 100,000 tons of processed chemicals, and 5,000 industrial robots that won't roll off the production line in the next fiscal year. And when the heartbeat of German industry slows down like this, it doesn't just shake the assembly lines in Stuttgart or Bavaria. The tremors reach the software firms in North Rhine-Westphalia, the robotics designers in Munich, and every supplier linked in the chain. The tariffs have set off an industrial shockwave in Germany. But the story doesn't end there, because these German exports are tightly woven into the fabric of the American economy. Here's the part many Americans don't realize. German cars in the U.S. aren't just imports sitting in showrooms. They're part of a massive economic web that stretches deep into American communities. Take BMW's plant in Spartanburg, South Carolina. It produces about 450,000 vehicles every year, many for export, but also a huge share for U.S. buyers. Mercedes-Benz in Alabama rolls out another 275,000 SUVs annually. Together, these plants support tens of thousands of workers, plus an entire orbit of suppliers, from plastic parts makers in Wisconsin to electronic module factories in Ohio. When luxury car demand falls, these U.S. plants don't escape the pain. They start cutting shifts, reducing hours, and slowing orders. One lost shift at Spartanburg alone has a ripple effect across 60,000 jobs spread across multiple states. Dealerships feel it too. The luxury market in the U.S. sells about 2.2 million vehicles a year, with roughly 720,000 of them German brands. If tariffs slash those sales, dealers lose inventory, financing dries up, and jobs disappear. According to KPMG's models, a 40% contraction in the luxury segment could mean 75,000 American jobs lost within 2 years. Most of them not in factories, but in dealerships, advertising firms, logistics companies, and finance offices. And then there's the credit market. A staggering 81% of U.S. car purchases are financed with loans. German brand customers typically borrow around $51,000 each, and collectively, their auto loans add up to about $110 billion in the U.S. banking system. If German car sales fall by 40%, that's about $40 billion in high-quality prime credit that vanishes from bank portfolios. In other words, the same financial system that helps Americans buy homes and fund small businesses suddenly gets squeezed. The tariffs were designed to punish Germany, but by choking German imports, they also starve the U.S. of jobs, credit, and consumer choice. And these microeconomic shocks are already feeding into the bigger picture inflation, interest rates, and even government debt. When imports shrink and domestic production can't instantly fill the gap, something predictable happens. Prices rise. Economists call it scarcity inflation, and that's exactly what the U.S. is now facing. So, luxury cars are really the first to feel it. With tariffs raising showroom prices by about 12 to 15% overnight, a lot of buyers just step back. Some folks delay their purchase for a year or two, while others start looking at alternatives that, honestly, don't really satisfy them. The result? Well, there are fewer sales, but prices don't actually drop. Instead, dealer inventories shrink, and the luxury car market slips into a sort of partial scarcity. That scarcity doesn't just stay isolated. Cox Automotive predicts that around half of German SUV buyers will delay their purchases simply because they can't find a real substitute. This kind of hesitation pushes demand into the future, but it keeps prices high today. Even if only a fraction of those delays show up in inflation data, it's still enough to nudge the consumer price index upward. Economists estimate that tariffs could add about 0.15 percentage points to the luxury segment's CPI. Now that might sound tiny, but in a delicate economy where the Fed tracks inflation down to the decimals, it's actually a pretty big deal. Here's why. The Federal Reserve has been keeping rates at 4.25%, hoping inflation drifts down. But if core inflation sticks above 3.3%, the Fed may have no choice but to raise rates again in early 2025. Higher interest rates ripple across the economy, raising the cost of mortgages, business loans, and credit cards. Meanwhile, bond markets are already reacting. Analysts expect the yield on 10-year U.S. Treasuries could jump 45 to 60 basis points as investors price in higher inflation and bigger deficits. And here's the kicker: with higher yields, the U.S. government's debt service bill could balloon to $800 billion a year by 2026. Add a geopolitical twist. Germany has quietly signaled that it might withdraw 1,236 tons of gold from the Federal Reserve's vaults. That's not just symbolism, it's a pressure card that shakes confidence in U.S. financial stability. So, tariffs meant to protect U.S. jobs are now feeding into higher prices, higher interest rates, heavier debt costs, and even global financial uncertainty. On the campaign trail, tariffs make for a powerful slogan, "I'm protecting American jobs," but in practice, the political math is far more complicated. Take the states most affected: South Carolina, Alabama, and Georgia. These are deep red Republican strongholds where BMW and Mercedes factories are among the biggest employers. When those plants cut shifts because of weaker luxury demand, thousands of local workers feel it immediately. It's not just factory hands on the line. Suppliers, cafeteria workers, and transport firms all depend on those shifts running at full speed. A policy advertised as protecting jobs could end up cutting paychecks in Trump-friendly districts. The same contradiction shows up in Michigan and Ohio. The United Auto Workers Union might be expected to celebrate fewer German cars on U.S. roads, but reality isn't so simple. Many parts for BMWs and Mercedes are actually sourced from American suppliers in these states. Fewer German imports often means fewer orders for local parts makers. The financial exposure is huge, too. For German companies, North America represents around 30% of Mercedes-Benz earnings, 28% for BMW, and an even larger 42% for Porsche. A collapse in those revenues shakes Germany's stock market. But it also hits U.S.-listed dealership groups like Lithia and Penske, whose share prices depend on steady luxury sales. Local politicians can already see the writing on the wall. Governors and senators in these factory states are preparing to pressure Washington if layoffs begin, because when midterm elections arrive, slogans about teaching globalists a lesson may ring hollow if voters are staring at padlocked gates and empty shifts. So while the White House frames tariffs as a patriotic win, the reality on the ground could turn into an electoral headache, especially if job losses spread in the very regions that form the backbone of Trump's political base. Some might assume that if German luxury cars become scarce, buyers will simply switch to Japanese, Korean, or Tesla models. But in reality, replacing German brands is far from simple. Capacity is a major constraint. Lexus, Genesis, and other Asian luxury manufacturers are already near their production limits. Tesla, meanwhile, faces supply bottlenecks in chips, batteries, and aluminum. And, well, new U.S. tax credit limits have doubled the effective price of models like the Model Y. Even if Tesla captures 15% of the lost German market, it just can't make up the full gap. Then there's consumer behavior. German brands have spent decades building a perception of safety, driving experience, and prestige. That trust isn't transferred with the flip of a switch. Dealer networks, lease programs, and brand financing all add friction to substitution. Many buyers simply wait or postpone their purchases, rather than settle for a non-German alternative. The numbers are honestly striking. Total luxury vehicle sales in the United States could fall short by as much as 250,000 to 300,000 units per quarter. For a bit of context, the United States sells roughly 17 million light vehicles a year, so this really represents a significant contraction in just the luxury segment. Secondary markets are feeling it too. Dealer chains like Lithia and Penske, along with medium-sized parts suppliers in the Russell 2000, are already warning about profit hits. The thesis that Japanese or Korean brands will fill the void is, well, appealing in theory. But the reality is that supply bottlenecks, high prices, and consumer loyalty make a full replacement impossible, at least in the short term. The result? A luxury car shortage, rising prices, stressed suppliers, and a United States economy quietly feeling the pinch long before any political talking points land in the news. Here's the final picture. Washington's tariffs are designed to protect American jobs and improve the trade balance. But, the reality is far more complex. By restricting German imports, the United States faces scarcity-driven price increases, tighter credit flows, rising interest rates, and even pressure on government budgets. At the same time, German factories, American suppliers, and dealership networks all suffer losses, creating a ripple effect across the economy. In simple terms, tariffs may look like protection on the map, but for everyday Americans, they translate into higher car prices, fewer financing options, and honestly, slower economic growth in affected regions. The very communities that were supposed to benefit may end up feeling the sharpest pain. The luxury steering wheels that once rolled across United States showrooms now touch fewer hands. And, well, the emptiness in those lots is a reminder of the unintended consequences. Exports from Germany drop by $110 billion. Dealer inventories shrink, credit tightens, and the Fed faces new inflation pressures. The White House may celebrate a trade victory, but the economic dominoes tell a much more complicated story. So here's the question for you. Is this truly a win-win with a tariff wall, or a policy that protects headlines while creating hidden costs for consumers, workers, and investors? Share your thoughts below. Do you think the United States can find a way to grease the wheels again? Or is the luxury market quietly closing off? And if you want deeper dives into tariffs, supply chains, or how interest rates respond to trade shocks, just let us know.